Hello everyone, welcome to this webinar today where we're going to be discussing predictive accounting, helping clients navigate the future. I hope you're having a great day. I'm Peter Towers, Managing Director of BIZTOOls. Let's look at trends in our market. What's affecting accountants and bookkeepers? It's predicted that the amount of basic compliance work will contract over the next couple of years. So what's that going to mean to your accounting firm? Clients are going to be able to direct communicate with the tax office a lot easier, especially clients in the wage earner, salary earner type categories. SME clients need help to grow profitably and survive. That's very obvious when we look at the new financial year, which is to start in a couple of days' time, isn't it? Forecasts of high interest rates, high inflation rates, and that dreaded word recession is getting used more and more in the media. And team members are looking for career interesting work. In survey after survey in the last 3 or 4 years, practitioners have been complaining about the problems in getting staff and then retaining staff. Well, I hope that today's discussion will help you a bit in that way. If you have any questions during the webinar, can you please send me your question on the chat box. If you are watching this webinar at a later time more suitable to you and you have questions, please send me an email, peter@essbiztools.com.au. A couple of questions for you to consider. It's the end of a financial year. We've got a difficult year in front of us, and perhaps another year as well. So what about you as an accounting practitioner? Are you caught in a compliance trap? Too many small clients unwilling to pay more? Not enough experienced team members to help? Working long hours under pressure? This is the general impression I get from a significant number of accountants around Australia when I talk to them. People tell me they want to do compliance, they want to do business advisory work. They want to ease back on compliance. But a lot of people don't seem to ever do it. There's a need for advisory services for many SME clients, but not all SME clients, of course. Not all of them are going to be willing to pay for it. Some of them can do this work themselves to the level they require. Or some of them have spouses or children or friends who will do it for them. According to the latest reports from the government, there's over 2 million small businesses in Australia. Now, we all know that some of them are in the same ownership, sometimes 2 or 3 of them. But in round figures, there's got to be 1 million to 1.2 million of individual SME business units. There's a lot of market for 10 or 12,000 accounting firms to handle. And I know that a significant number of the accounting firms are just not interested in doing this sort of work. I don't know what those firms are going to do as the tax work reduces over the next few years, but it's up to them to find out at that time. So is it real? Are these problems in this industry real, or is it just false information that's been circulated? Or is it of your own making? Do you like doing compliance work? And there's nothing wrong with that. But you shouldn't be making excuses about why you're not doing other work. You want to do compliance work, that's great. I don't know what the end result's going to be, though. Are you interested in assisting your clients to run better businesses? If so, something's probably got to give. Because as I understand it, talking to accountants after accountant all around Australia, everyone is saying they're busy. So if you're busy, how are you going to find time to advise clients on advisory work? Especially the subject we're going to talk about today, predictive accounting, which flows into Chief Financial Officer services. So what is predictive accounting? Business leadership teams need to think about the future. That's very important. Various surveys have indicated that most CEOs of large businesses spend 80% of their time planning the future. I was the company secretary and chief financial officer of a listed public company. I think my chief executive officer probably spent 70% plus, to be honest. I don't think he did 80%, but he did a lot of planning. I talked to a CEO of a fast-growing company at one stage. It was also a listed company. And he told me he was spending 90% of his time on planning the future. And he was looking for a chief financial officer who would take up a lot of the planning operations with him. So most spend a lot of time on planning their future. How much time do your clients spend on planning the future of their businesses? Because I think this is one of the reasons there are problems in some SMEs. Not enough time has been spent on planning. But the CEOs of a large business don't do this on their own. I know I was the key financial advisor in one of those leadership teams in a public company. A lot of things are done as a group, and the CEO would probe and ask questions as he planned the future of the business. A very important person that assists the larger company CEO in this planning is the chief financial officer. But who do your clients go to get this sort of input? I think where you start is looking at the strategic plan. And I don't know how many accountants have prepared strategic plans for their clients for the new financial year, which starts in 2 days. I know some have, because we've had them in webinars, and they went through their planning process in March, April, May with their clients. But they're firms that are concentrating on delivering business advisory services. Sure, they still do tax returns, but for their business clients. And they have sold off the wage earner, salary earner returns to other accountants, mainly younger people that wanted to get started, wanted to get some experience, wanted to get used to interviewing clients. So there is a market to sell those clients off. And they use that money to invest in various programs. And I now know at the end of that particular podcast, I was told that the firms that had been featured were in fact subscribers to ESS BIZTOOLS. That made me feel happy. So we need to look at the strategic plan and then look at having systems. Now we're nearly at the 1st of July already, so you can do this next week or the week after, and then try to get in a habit in future years of doing the strategic planning a little bit earlier. Because I think the predictive accounting process is the financial interpretation of what's in the strategic plan or the business plan. You would have budgets for each profit or cost center, and the use of internal transfers for transactions between various profit or cost centers is important, because they will undoubtedly be transferring products or services between one another. And the key is that you're able to produce financial projections that are accurate for each individual cost or profit center. It's very important that there are key drivers. And in fact, I think key drivers get overlooked completely in a lot of conversations about budgets and cash flow forecasts. The key drivers are vital because they relate to activities which have to be done and which can have a significant financial impact on a business. And I've listed some of them here for a manufacturing business. Components used in production, mainly because I've been sitting here working on a manufacturing business in its predictive accounting and changing its accounting format and its reports when I was writing these PowerPoint slides. The inventory of components. This particular business I'm looking at has got about $500,000 to $700,000 tied up in its investment in inventory for components. Needs proper accounting review, I thought. Inventory of completed products, labour planning schedules. All manufacturing businesses need that. We should have a analysis of debtors with a calculation of the closing balance and then the calculation of what the implied debtors days outstanding will be. Now, if you do up a projection and you've got a debtors days outstanding of only 21 days and historically it's sitting on 50 days, I think you've got a problem. Your budgets and your cash flow forecasts are going to be wrong. You need to analyse work in progress and make sure that progress claim invoices are being raised regularly. Creditors days outstanding within the creditors analysis is important to note. And what is very important is to utilise this preparation of the budgets and cash flow forecasts to make sure that the key creditors are being paid in accordance with their payment terms. The key suppliers, that if they don't like your client because they're not paying them strictly on a 30-day basis or whatever it happens to be, they're likely to stop supplying them and go to someone else. Could wreck a business. What are the key performance indicators relating to the entire accounting report process? One of the key things that I learned in a public company environment was how important key performance indicators were. They basically run the businesses around those day-to-day calculations, many of them daily, then weekly and monthly. And the managers of various activities know what their gross profit percentage should be, know what their labour to turnover percentage should be, know what their rework percentage has been budgeted at. And if they go over it, they're going to get asked questions. So it's very important that as accountants, we understand the importance of these documents and make sure that they're accurately prepared. Cash flow forecasts and projected balance sheets are key items, obviously, in predictive accounting. So I think this entire process is the entree to a virtual chief financial officer service for your clients. You prepare the predictive accountants, and then you've got tools to be utilised on an ongoing basis to see how the client's performing. So you can have comparison to previous actual financial with the individual business operations within the budget. And this is important. I've seen some very significant errors getting made in this budgetary process. I referred to one there before, that no referrals being made to the past at all. Now, I know we're predicting the future, and that's very important. It's important for accountants to accept the future is very important. And we need to be able to accurately predict the future, but we've got to take some notice of the past. If the business is trading day in, day out, month in, month out with a 50-day debtors days outstanding, there's no way that I know of that we could say it's going to reduce to 21 days, unless you have done a lot of work as the preparer of this document that justifies why that should happen. And I think it will be coming down in very slow increments to get to anywhere like 21 days. But I've seen people put that sort of information into the budget process. I've seen them produce projections that have suddenly got creditors up around 80 and 90 days outstanding. when historically they've been running at a bit over 40 days. Creditors won't allow you to get that high. They'll cut off supplies. And then where's your client going to be? And all that's doing is underestimating the need for cash within the business. That's part of the reason you're doing this plan, so you can accurately predict if they're going to need new funding in some way. And we'll talk about that in a moment. The analysis of key performance indicators, as I've said, is very important. There should be a comparison, though, of the key performance indicators that you're preparing in your budgets to benchmarking reports, like benchmarking.com reports. You can get reports from them for about 230 different industry groups in Australia. So you can analyse what the various key data figures are for particular industries. And if your client is a great variance, either plus or minus to those figures, that should be ringing some alarm bells. And that's one of the reasons you prepare that, so they can see that. Expenses need to be reviewed line by line. I'm on a board with a very experienced lady who's developed companies in a couple of countries. And she tells me that she goes through every month and gets the general ledger and looks at every expense account and wants to see the composition of what's included. Same process should be applied within budgets. Margins, are they acceptable? Benchmarking can show you some information on that. I think it's an appropriate time to reviewing the chart of accounts that are being used by your client. Make sure it all ties up with how you're developing the budget, so that ultimately that will flow through to the profit and loss accounts, which will mean obviously that in some cases the chart of accounts will be amended so that there's some continuity. There's not a lot of, oh, well, we called it this in the budget, but it's obviously not called that in the profit and loss account. That's just time wasting and causes a lot of confusion, especially when a director or a leadership team member has the budget and then looks at the profit and loss account and says, well, where's this expense? That's been called something else. I think there should be a lot more control over chart of accounts, that people should not just be able to create a new account. It should go to the chief financial officer if you're acting in that role to get authority. So you make sure that it's understood how it fits into the overall system. So the key drivers are the workhorses of the predictive accounting process. Anyone can do up a budget and a cash flow forecast and just hope it's all right. But if you've done these sub-accounts and have really looked at these balances and then what they represent in debtors' days outstanding, creditors' days outstanding, and number of days things are taken to be done. Review the margins, review investment levels, monitor cash flow implications of inventory, investments, and payments. You know, a lot of businesses either consciously or subconsciously increase their investment in inventory over a year. They started off with $1 million in inventory and they just keep on buying and buying, and suddenly they got nearly $2 million. Why? It's eating up a lot of cash. Do they need it? Or has there been an automatic purchase reorder in their computer system that's just been buying it back in? Have sales not been as high as they expected, but someone forgot to turn off the production line or the buying line to get stock? This is why budgets need to be used as monitoring tools throughout the year, not just thrown in a bottom drawer and forgotten about. The cash flow forecast obviously gives us month by month cash projections. The key thing to be looking for if there's any problems. So is the client going to be outside their approval they got with their bank? So how are the shortages going to be fixed? Are they going to go off and talk to the bank manager? They'll be good if they can find one, won't they, these days? But who do they talk to? What do they do about it? That's why they've done the forecast. If they're looking to borrow money, does the business have security they can offer? to a bank or lender to get that money? Could there be a reduction in an expansion program that the business has started because you've got to say to the CEO, we're not going to have enough money? Or perhaps it's a research and development project. Can it be slowed down a bit, even though it might be vital to the future of the company? Company's got to survive, otherwise there's no future. Is it possible for the business to secure a significant government grant? Perhaps there's been research and development undertaken, and we're now at the end of we've got a prototype, we now want to commercialise. We look for a government grant. Now, there used to be one called accelerating commercialisation, but that got phased out on budget night, and the Treasurer announced that the government's going to introduce a suitable replacement to accelerating commercialisation later in 2023. We're all waiting to see what happens. Hopefully it's very similar to the very successful accelerating commercialisation, which ran for 15 years. Perhaps the cash flow forecasts are going to be to such a degree of problems for the business, they need to think about raising some capital. Well, there's three opportunities that I am familiar with when it comes to private companies or private businesses raising money. They're going to have to, if they're a private business, a partnership or a sole trader at this stage, they're going to have to incorporate and become a company. It's very hard for a sole trader or a partnership to raise capital, unless you've got a new partner prepared to go into a partnership, and they'd be taking some risks, wouldn't they? So we could look at a company trying to raise capital. Well, there's Section 708 of the Corporations Act. It's been there for 40 years. The company can raise up to $2 million in a 12-month period from no more than 20 investors. It's legislation that was really targeted about raising money from friends, colleagues, family members, people you went to school with, played football with, or had a knowledge of your business. They might have been a customer or a supplier, but not the public at large. You cannot promote or market that you're looking for money under Section 708. But you don't need a prospectus. There's no real formalities. You just go up and approach people. Just remember there's a limit to a private company only having 50 shareholders, and you go to the public for 2 or 3 years, you probably use up that 50 shareholder limit pretty quick. The next way is the early stage innovation company. Now, this is great for a young company under 3 years of age that's been developing new products, processes, services, marketing or management methodologies. So they've been involved in research and development. They've developed something new. They got turnover of under $200,000 in the last 12 months. They got expenditure of under $1 million in the last 12 months. They could be a candidate for that status of an early stage innovation company. The real benefit is that the company gets the money, but the reason for them getting the money is that the former government introduced carrots for them, and the carrots are a significant tax offset that's available to the investor. And probably the biggest carrot of all, as long as the investor holds those shares that they get issued for more than 12 months and less than 10 years, there's no capital gains tax. If they still own the shares after 10 years, the company can be revalued and they have a new cost price for their shares established 10 years on. So it's great for young companies. That's why the government introduced the incentive for investors to take a serious look at these types of companies. And then we've got crowdsourced funding equity raising. It took a long time for Australia to get it. We were 6 or 7 years behind the other major Western nations in introducing it, but we've got it now and it's working. My big problem is that the intermediaries who were appointed by ASIC, and there are 16 of them, but really only 4 or 5 active, they're not getting enough deal flow. And the deal flow they're getting is not up to standard. In fact, one of the intermediaries claims that they only seriously look at about 2% of the people that come and talk to them. I think that's a shocking indictment on Australian business, and perhaps on the accounting industry if accountants have been advising these people. They need budgets, cash flow forecasts, projected balance sheets, business plans, a vision for where they're going. and a clear understanding of how they fit into this new enlarged entity. They need social media presence because they can advertise and market once they've got the okay from the appointed crowdsourced funding intermediary. So it's a way to raise up to $5 million in a 12-month period, as long as their turnover is under $25 million. Their gross assets worldwide are valued at less than 25 million. They're not listed on a stock exchange anywhere in the world. So they can raise money. There is a process. ESS BIZTOOLS has got detailed packages covering each of those three items to help you through that process. So that's one way you might be looking at how you can fix the cash flow problem that's emerged out of predictive accounting reports. And then we've got projected balance sheets. Now, in the past, I think balance sheets have just been used to make sure the thing balanced the cash flow forecast. I've seen some horrible errors where people were not even using a balancing balance sheet, and they made great errors in budgets and cash flow forecasts, but we won't go into that. Predictive accounting reports preferably should be prepared over a 3 to 5 year period so we can see where the business or company is going. Because what it enables is a future picture to be produced. If you continue on this way that you're running your business, you raise $1 million in shareholder capital in year one, and you perhaps raise another $1 million in year three, because you're expanding or you're funding new research and development, you're growing your business. This is what your balance sheet's going to look like in 5 years' time. It can create a great target for your clients to aim at. So I think it's great. We use Plan Guru software to prepare these projections, and it facilitates every component of predictive accounting that I talked about. So is your client happy with this financial projection and what they're going to look like in 5 years' time? They might say, geez, we're doing a lot of work and we still don't seem to have improved our position. So maybe you've got to go back to the drawing board. So the challenge is to work with your client to ensure that the future picture is actually created. That's the hard yards after we've gone through this process. This is the real yards for virtual chief financial officer performance. We've done the predictive accounting reports. We now have to implement. So let's look at some of the things that I think you would implement. We are strong advocates for the introduction of 52 week of the year financial services, but over 365 days. So the first thing is daily. Many of your clients need daily key performance indicators. Many of them probably got them. You mightn't even know about them. But if you're going to be offering a virtual CFO service, you need to understand it. So we could look at the number of customers, the average sale. There could be a large number of other ones for particular clients. It could be the consumption of electricity or the usage of water or gas or whatever, are key figures that management needs to know. So you need to understand them and make sure the system is going to produce that for them. What about weekly? I come out of a public company that ran its whole business around weekly performance estimates. Quite honestly, I don't think my CEO read the monthly financial accounts. He glanced through the annual ones. All he was worried about was, how did we go weekly? What do the weeklies show? And basically, at the end of each month, he'd say to me, do the weeklies line up with the monthly accounts? And internally, we had a target of about 98%. So the weekly estimates, which I've got there, include like a performance report, number of employees, number of accidents, those sort of things. The profitability estimate, which is an estimate, and the comparison back to budget. Break your budget down. So you've got a month, but divide it by 4 or 5, and you've got weekly turnover figures or cost figures that you can compare to your weekly results, because the quicker you find out where the problems are, the quicker they will get fixed. Unfortunately, because we've handled SME clients traditionally in Australia as just coming to accountants to have tax returns done, and then your set of accounts, they're really only getting a lot of this advice annually. This needs to be undertaken the same way that larger businesses do it. And it happens there daily, weekly, monthly. And it's the same cycle repeated again. It's repeated 12 times in a year, daily, weekly, monthly. Can you offer this to your clients? A growing number of firms are. Then on a monthly basis, we should get a monthly profit and loss account for each of these profit or cost activities that we've identified back in the original budget. It's been set up. Hopefully you've made sure the chart of accounts is right so that there should be no big questions as to what this particular expense or income item related to, because it should be the same as its original definition. What's the comparison to budget report for each profit or cost activity? The key performance indicators, they're very important, all those percentages, so that people can see how the business is going. In the monthly financial report, you should be commenting on variations, drawing to the leadership team's attention. And the same thing with the key performance indicators. Make sure they've noticed it. Invariably they do. That's great when you've got a line of figures and there's already 7 months there and you can and something just jumps out at you, doesn't it? But you need to make sure that's getting prepared and has been checked and analysed first. It's a bit embarrassing if you're getting people to get their blood pressure up looking at something and then you find that there was an error made in that calculation. So you need to make sure these things are checked before they're tabled for the leadership team to review, because they can be a bit unforgiving when mistakes are made by accountants or by clerical people. I think the monthly Board of Advice or Directors meeting is a very important finale to this whole process. You've prepared a report, you've commented on the financial performance. It's where you can sit with the board of Advice. You might be a member of the Board of Advice. Hopefully you are if your client's got one. Directors meeting, you may or may not be a director. You might not want to be a director, but you, I think, should be invited to present as the CFO, if you're doing that role, to the board. Give them an overview of how things are going. What have you achieved from offering this type of predictive accounting and virtual chief financial officer service? I think there's a lot of benefits. So let's look at them. You've ensured that all aspects of the business have been financially analysed daily, weekly, monthly. This is a 52-week business cycle, which is vital for businesses to implement. People come and talk to me when I wear my consulting hat and are talking about scaling up and doing all sorts of things. Or they're doing a research and development project and now they want to go to the market and raise $1 million so they can get that product into the market. But I take them back to ground zero and say, this is the system that has to be put in place. Otherwise, I'm not prepared to talk to you. My colleague, Andrew Geddes, participated in a podcast with me a few weeks ago, which we've since produced a number of articles on that are on our website. And he said, if a client that has approached him to be involved in an external chairmanship role, which is the role that Andrew does these days, he insists that they must have a functioning leadership team. And he wants to meet the leaders and make sure they are committed. They're not just saying they're leadership team material. They've got to be switched on so that they are using the data that the system's going to produce. They are sitting around planning the future. They're not leaving it all to the CEO. So the 52-week business cycle, I think, is very important. And it integrates quite nicely with what we're talking about. Most SMEs, not all, but most SMEs will have difficulty in implementing this type of system unless they have an accountant who's prepared to offer these types of services. And even some of them that might have someone employed internally they call an accountant might not be interested or capable of supplying the type of services that I've referred to today. So there's a great opportunity. Look at your clients. Look at the ones that are keen to grow. They might currently only have a turnover of $1 million, $2 million, but they're wanting to grow. They'd like to have 5 to 10 million. They need this input. Otherwise, they will never make it and retain it successfully. Something will go wrong in their business. So I think leadership team members should be spending at least 40% of their time planning the future. That might be obviously sitting down working on predictive accounting reports, analysing, looking at what their competitors are doing, looking at what's going on in the marketplace. What are the trends that affect their industry? That's the future. And then bringing it back to their meetings and analysing. I think your CEO owner clients should be working on at least 60% of their time in this futuristic planning, thinking of where the work's coming from. How are they going to get it? What new facilities do they need? What team trainings needed? What corporate governance trainings needed? What management services trainings needed for their team there? And what's going on in succession planning? And I think succession planning is applicable to every team member, because the more businesses can do to develop and nurture their own people in-house, I think it's the better. They get outstanding people for their organisation. But someone's got to think this through and plan it. It just doesn't happen. And in all this, if you're offering that CFO role, you will have a inside advantage on all of this. But you mightn't stay there forever in that client. The client might grow too big. They get up to a $50 or $60 million turnover. They might then decide, hey, it's about time we had a full-time CFO. Well, that's part of the game. I think that you need to accept that might happen. To go, so you should continually be out there looking, trying to attract new clients. So you've got them, because some of them will succeed fantastically and will be looking for a full-time input. In the meantime, you could be helping them get to that stage. So what effect is predictive accounting going to have on your firm? As accountants, it will enable you to assist your clients to navigate the future. And in this next 12 months, we're going to see plenty of challenges. I mentioned before, high interest rate, high inflation, that dreaded word recession getting mentioned. Your clients are going to need assistance to navigate these different. Otherwise, there's going to be substantial business failures. Your accounting team members will be happy. The reports that we keep on getting say that accountants are having trouble attracting and retaining staff. Well, if you're doing interesting and challenging work, which this definitely is, I think they'll stay with you. Now, the ones that can't stand the pace, they won't want to stay, but you probably didn't want them in any case. And that's the marketplace reality, isn't it? Your clients will be happy. They will know that you're working with them as part of their team. Not this person they only talk to once a year or maybe twice a year, but someone who they're going to be talking to at least every month. And you can do it by Zoom if you like. I'm on a board. We have all our meetings by Zoom. It's thousands of kilometres away from where I live. It's not quite as good as having face-to-face meetings. We try to have 2 a year face-to-face meetings. But the rest can be done by Zoom, quite successful. Your firm will be in a better position because you're earning fees from a diversified services. Fees that can be very attractive if you're delivering the services and you're helping the client grow so they can afford to pay your fees. If they stay still, it's not going to work. They won't be happy, so they won't be making enough money to cover these extra costs that they're incurring. Okay, so ESS BIZTOOLS can assist you to achieve all this because we've developed product packages to cover everything I've talked about today. And some of them have been in the marketplace for a few years, others are basically brand new. We continually are producing new material. We've discounted our prices because we have made a commitment. In fact, we've basically made a promise in various webinars to the Australian accounting industry that we're going to help the industry really come to grips with supplying these additional services that I think are very necessary to SMEs in 2023-24. That's our commitment to you. And because of that, we have reduced our prices. Because whilst we think our original prices were right, we're taking the commercial gamble of offering significant discounts to get you started. The prices will go back to their proper level in a year's time, by which time I hope that you can really see the benefit in your businesses. If not, I really want to hear from you, because one of us is doing something wrong. Either I'm doing something wrong or you're doing something wrong. And we need to then find out what it is. So we have a special launching for advisory services. Normally our starter package, which would get you started, starts at $2,100. We've reduced that to $1,529. And through to the end of July, we are offering that for a 15-month subscription. 15 months for $1,529, which also includes GST. And we've got some holiday accommodation package vouchers that we acquired until they run out. They'll last for the next week or so, I suspect, but you'll get 2 of those. Now, that's for the special offer, which to subscribe, you can go to our website, www.essbiztools.com.au. You can also subscribe to our starter package, which currently is about $2,500, and you can see that on our website. Want to know more? Please go to our website, www.essbiztools.com.au, and have a look at what's in the packages that we're promoting. Or you can contact us. You send me an email, peter@essbiztools.com.au. I'll then organise a Zoom meeting with you, about 45 minutes, to discuss your firm, and clients, your team members, and I'll give you an overview of the services we could supply to you to help you deliver the services you want to deliver to your clients. Or if you prefer making a phone call, just pick it up now, 1800 232 088. It's the best number to get me on, and we'll either have a discussion today or we'll immediately set up a Zoom meeting over the next couple of weeks whereby we can discuss the issues. I don't seem to have any chats, requests. I hope I've given you a good overview. I honestly believe there are challenges out there in the marketplace that accountants committed to offering this broader range of services can deliver for our clients. But we need to create an atmosphere around Australia whereby accountants take this on as a challenge. In fact, I think it's a very attractive challenge. It's interesting and challenging work, and you'll get paid for it. Our next webinar, which is on next Thursday, is strategic review. It's not too late. You might recall that in today's presentation, I said that some people had done these in March, April, May, June. But you can still undertake a strategic review for a client. And we're going to work through the process on Thursday, the 6th of July at 12 noon. Incidentally, we are also organising a detailed process for predictive accounting, showing you how it works. We're just coordinating with a director of Plan Guru in America to be available. And this will be presented sometime during July with Paul Barnaby, who's the Australian representative for Plan Guru. He's a very experienced chartered accountant. and myself, and we'll give you a more hands-on process of using the Plan Guru software. We haven't been able to confirm that date yet. We will have it confirmed in the next few days, and then we'll be communicating with everyone, letting them know. It will be on at 11 a.m. though, to suit the time in America. It's not been too late at night. Okay, so thank you for being with us today. As I said before, if you have any questions, please contact us. We will be sending certificates for CPD participation to you who've attended. Those of you who watched this webinar in your own time, unfortunately, we can't do that because we don't know how long you actually watch the webinar for. We can tell you it's gone for 46 minutes. So you can put that in your declaration to your professional body. Thank you very much. Have a great day and happy end of financial year tomorrow. And I hope July 1, which is a Saturday, sees the start of a successful year for you and your clients, and that you're able to help them to overcome the challenges that 2023-24 are going to present. Stay safe. Goodbye. And I look forward to hearing from you. Thank you.